Hey there. Okay, video number 33 overall, but video number 17 of module 2. And in this particular video, we're going to talk about the moving average. Now, the moving average is probably one of the most vastly used moving tools, indicators out there in the forex or stock market industry. All right, so we will be using the moving average a lot. Now, the moving average, it lags. Okay, and what it basically does is just go ahead and apply this on the chart first of all. I'm going to reset that, and I'm just going to leave that black so everybody can see it. Now, what this basically does is it calculates the previous 14-day periods, and it applies a moving average of simple. It basically closely monitors the true results of highs and closes and stuff like that. Okay, and then it will go ahead and it will apply the moving average on the chart and according to wherever the prices have moved. Alright, now we can apply a second one on here. Now there's no limit to the amount of indicators that you can actually apply to your chart, right, but it's not going to make sense by making the whole chart congested to the point where you can't see anything. Right, let's just change this to a different color, to a color that I think that would make some difference that we can see. And now I'm going to make this a bold color, forest green. Now this one was set to a 28 period. If I can just double click on that somehow. This was set to a 28 period, and this one here, if I can get on it, it won't let me open it. And that one's set to a 14. Now the 14 is referred to as a faster moving average compared to its neighbouring moving average, which was set to a 28 period. And the 28 period will lag. It won't follow the line of the candles in great detail. I could put another moving average on if I want to, and I can show you one where it really follows tightly to the let's just find a color, to the candles. Now you can see now how this red line has followed basically in line more or less with the candles. So that's a much faster moving average. Alright, so the higher the period you have in there, the slower it becomes because it's measuring more data. Okay, so when you see these highs and these lows, it then creates this offset, and it moves it further away from the candles. And the further the way that these move away from the candles is an indication of a continuation of the downtrend or the uptrend or whichever it's going in. Now you can see that how far away that this is moved away. So the further away the moving averages are away from the candle prices, the better. And as the candle prices come closer to the moving average, it's time to basically prepare to either protect your trade or to close out if you trade, or prepare to go in the other direction. Okay, now let me just remove this out of the way, and let's just give you another example of what we can do here. Okay, alright, I'm just going to go ahead to my indicators list and just remove a bunch of these and just stick with one of them for the time being. Now, this one here I believe is actually the default. Okay, so it's set to a period 14, and I've just coloured it black. I'm going to make it a darker black for here for this example. And what we can do is define buying signals, which is referred to, at least what I name it as, is called the penetration technique. And what we're looking for is where the candles actually break through the bottom and pierce through the top. Okay, and then you go long on the next bar. You then go, if you're going long, you then close that trade at the first instance where any candle, no matter what color, penetrates the 14 moving average again. And then what we look for again is for another signal. So here we can see this red candle here actually penetrates below, and then we go short on the next candle. Alright, and then we target previous support or resistance levels depending on which direction that we're going in. And here it breaks again, go long, and target again previous highs or what have you. All right. But it's not your perfect indicator to use because, I mean, if you go down to a lower time frame, or even lower than that maybe, or even different settings, um, it will get to the point where you're going to be making a few good trades and a few bad trades at the same time, really. So, like, I mean, here there's an instance where the market basically goes sideways. So there's like buyers and shorts all in one area. So you don't really want to have that. So what we can sometimes do as well is go ahead and put in another moving average. Doesn't really matter what color they are, to be completely honest with you, but we can go ahead and set it to maybe a 28 or whatever. Alright, and then when these actually cross over, you go long or short. So here you can see this one's crossed above. Sometimes it might actually do you better to change it a different color. Well, black's okay, so we can use, let's use red for this because red comes out red or dark purple for colorblind people, so that should be okay. So you can see this black one, which is the faster moving average, is the 14 moving average, and we've got this red one, which is the 28 moving average, is a slower one. So when the faster one crosses over the slower one, it's a time to go long. Okay, and then when it crosses over again, it's time to close that long. Alright, now here is where the this time the red crosses over the black. You don't want to do that because we want the black to cross over the red. Alright, we want this black to cross over the red to go long. We want to go long at that particular point there as well. Okay, and the market does eventually go up, but it's not a great trade. I mean, it goes up 200 and, oh sorry, that's 27 pips, so that goes up for 27 pips, so it's not a great amount. But again, as I say, when we go in for these buy trades and what have you, or sell trades, we need to mark out our support and resistance levels, which will also dictate whether we take that trade on or not. Alright. Now, what's also important as well is not to go long or short at the wrong times when you see these crossovers. You'll see, again, this is all about patterns here. Right, you can see there where the black crosses are under the red, and you can see this candle right here. It's very, very close to where it actually crosses over, and the market does indeed drop. If we can zoom in a little bit. Here, right here, where it crosses right here, the candle is very close, and then eventually the market drops. Okay, then take a look at where this black goes over the red, which is also what we want for a long trade, but look how close they are away from the candles. It's quite far away, and what happened is the market reversed instead, rather than keep going up higher. Alright, if we find an area in the market where we can actually see that the black has gone above the red and the candle prices are very, very close to it, you'll find you'll have a better outcome than you would having a bad outcome. Okay, it's only when you see these candles going like quite far away from each other, you can see here where the crossover happens there, but the sell trade appeared down the bottom and the market went up. Alright, now this is for basically like the impatient people that will either have like 10 pips here, 15 pips there, or whatever. Alright, now you can go to the larger time frames. Larger time frames are also pretty, advisable really to trade off, and only wait for instances like here's the black and here's the red. The black goes over the red, and we've got the candles basically more or less touching where it crosses over. That's a good opportunity right there. Now here is another one where the sell trade crosses, where the black crosses over the red, but it's still quite far away. But on the larger time frames, you can be, a little bit forgiving, but I'd still rather stick with, the same rule of thumb and wait for areas in the market where they've actually crossed, and where the market is very, very close to the prices as well, and then the market immediately drops, because you'll get more pips out of it at a quicker time. When you go in at a point where the market's too far away from the crossover, then you have to wait a little bit longer for that trade to get into profit. Alright, let's see if we can, yeah, so that's the same occurring pattern all the time. Now that's the crossovers. Okay. Now you could also use these two indicators as trigger alerts as well. So like for instance, here is where the market's gone up, and you can say to yourself, right, okay, I'm going to wait for a short opportunity, but I'm only going to wait when the two triggers have rung true. And the first trigger will be when the slower moving average gets broken first, and then when the second moving average gets broken, I will then go short on the second moving average, which will be the faster moving average. So when the faster moving average gets broken, which is my second trigger, I will get in on the next signal, on the next bar. Alright. So play around with those, and you can add as many as you like on here. Another one really is what most traders use, is the 200 moving average, and then they set it to exponential. Alright, and this is a true trend changer. When it breaks, you'll see several instances where it breaks by a considerable amount, and we're looking for the bodies to break. Okay, we've had that big downtrend, then we've had our first warning, alright, and then we've had our second warning over here, and we should get a third one, and it should break this 132.10.05 line. But you can use this 200 moving average to really get some large gains out of this. And any time it bounces off, just go short and just wait for an area. You can wait for maybe this faster moving average to be broken, and then wait for it to be hit again down here. I mean, cracky, that's like 594 pips there over 200 hours, in 2 weeks. So it's a fair amount you could be making from this. Alright. But when it breaks, it's normally a good indication to let you know that it's going to change direction as well. I mean, sometimes people put a 100 next to it as well. Okay, and they can actually use this as a trigger, so when it breaks here, go along and target the black line. Alright, here's another trigger pretty close. We can actually target that and hit this black line for 132.80 or 28 or something like that, 132.28. But I still think this is going to go up much higher. We've had two big strong candles here. We might see this actually touch the 131.50 area. We're around about 16 pips away from that right now. Alright, and also, I mean, you can do the gamma ray trading as well, which is by adding loads of indicators on there that are actually free periods away from each other, and or even up into 5. We'll show you those in the strategy sections as well. Alright, so how do you go again? Let's go a quickly brief recap. There's a couple of ways you can go ahead and open in these trades, and the best time to use these would really be off the larger time frames. Alright, they can work on any time frame you like, but the best times is when you see the market basically going in a straight line, and then when the crossover appears. That's one way. The other way is to wait for it to penetrate through one line and then go short, and then target maybe the second moving average, and vice versa. Okay, so play around with those settings until your heart's content. Play around with this for at least like 2 or 3 days. Okay, see how well you do before moving on to the next video. Alright, and until then, I will see you then. Alright, so bye for now.